Good morning, everyone. The time is rapidly closing in on 10 a.m. here in Stockholm, at least. But let's give potential stragglers another minute to join before we kick off these proceedings. So hang on for a minute before we get going. All right. A very warm welcome to everyone to this Q3 edition of the DSV and Xeneta Market Update webinar. We have a lot to cover today, so I will try and keep my initial words fairly short, but I want to give you a brief overview of what topics we intend to get to and who will be helping me out in trying to decipher what's currently going on with the air, ocean, and road freight markets. First things first, I am Anders Olsson, and I work for the Nordics and Baltics cluster of countries within DSV Air and Sea as a project manager. And in that capacity, one of the things I get to do, in fact, one of my very favorite things to do, is to host these webinars. I am no subject matter expert, however. So as usual, we have assembled a panel that are considerably more qualified than I am to provide an update. And for this edition of the webinar, they are Patrik Berglund from Xeneta. We have Jamie Burrows joining us from our UK team, who's the head of our ocean product over there. Thomas Elmelund joining us from Denmark, Denmark's head of air freight, and Christian Gertsson joining us from the Sweden Road Freight Organization to hopefully help you and me make a little bit of sense of what's going on. As usual, we have a Q&A section. It's up towards the right, I think, in Teams. Please do make sure to post any questions there, and we will try to get to them either after the presentations of the individual speakers or towards the Q&A section at the very end. Now, for a brief overview of where things stand in the world right now before I hand over to the panel. I've titled the introduction for this webinar Groundhog Day, which for anyone young is a mid-90s movie where Bill Murray's character wakes up and sort of relives the exact same day over again. And that's a lot like what it's felt like to me over the past few months with anything related to news about logistics. Here it would have been nice instead of the text to have a picture from the movie Groundhog Day, but copyright fears made me think better of it. So this little boring text will have to do for that sort of reference. But we are here in September of 2025, 3 months since last we spoke, and I am once again hosting a quarterly webinar where we need to talk about Trump and tariffs, we need to talk about concerns in the Middle East, and we need to talk about climate and weather impacting road and railway infrastructure throughout Europe as well. It's familiar patterns. We've all seen it before, we've been here before, we've done this before. But for as long as these topics remain relevant, we still need to keep addressing them. However, sort of slightly dreary it can be at times to have to do it. It is a must, and as usual we will try and do it in a way which is fairly energetic and informative, so to compensate a little bit for the repeatedness of some elements of it, right? But we start off with a familiar face and a familiar concept, because Donald J. Trump remains firmly at the center of global politics and in the headlines of every newspaper essentially across the world on a daily basis. There's a lot that can be said about that, but in this forum, let's focus specifically on the tariff implementations, because they are very likely to continue for the near to medium term, at least, to impact global trading patterns and the flow of ocean and air cargo, particularly across the globe. The latest status, as you may be aware, is that a US Federal Court of Appeals struck down a majority of the tariffs implemented by Trump on August 29th, but not all of them. However, some remain in effect, but the majority of the tariffs were struck down. And they did that on the basis that the so-called emergency that was used by the administration as the basis for being able to implement these tariffs without having Congress enacting them as law was invalid. However, the Court of Appeals did so without giving the verdict immediate effect, allowing the tariffs to remain in place so that the administration could appeal to the Supreme Court. They now have. And the case has been accepted by the Supreme Court, and they will hear it. And they will do this hearing on what's called an expedited basis, meaning it's a faster handling than they normally accord to a case like this. However, it's still not lightning speed. So best guesses right now, because they haven't yet given a clear timeline, is that sometime towards November or early December, these hearings could begin. And until then, we are stuck in this sort of limbo where we remain and have remained for large periods of the past 6 to 9 months since this new administration came into office. In addition to the tariffs for cargo moving to the US, we are also seeing from Trump a sort of worrying new approach as well, where he's attempting to impact trading partnerships that don't involve directly the US. An example of this is the call for the EU the other week to implement 100% tariffs on China and India to apply pressure to Russia over the war in the Ukraine. It all blends together into this sort of hodgepodge mix of geopolitics, right? In addition to what Trump is doing, the Middle East also remains in tumult in many different parts of the region, with the most relevant parts for this forum, of course, remaining the Red Sea and the attacks on commercial vessels by the Houthis. The Houthi prime minister was slain in an attack about 2 weeks ago, but despite this, and maybe to be expected, the Houthis are not saying we'll take it easy from now on. Rather, they are in fact promising in a statement to escalate their attacks even further. We are now closing in, hard be it to believe, on 2 years since the majority of cargo vessels started diverting around the Cape of Good Hope instead of going through the Suez Canal. I remind you that the first Houthi attacks on commercial ships at scale were in November of 2023. And for now, the situation seems completely stuck where it is. Every now and again, we see positive signs and quickly followed by less positive signs. And we remain there too in this sort of unsatisfying limbo of a situation, waiting for something to move and something to change. Predicting the future, as you can tell from what's going on in the world, remains highly challenging, if not outright impossible. Like betting your fortune on a zero in roulette, it's a risky proposition. Today, we'll try and give you a good summary of where things stand and where we could be heading next, but hedging one's bets remains as relevant as ever. Before handing over to Jamie to talk a bit about the state of ocean freight, just again, a quick reminder to please post your questions, comments, or other input in the Q&A section, and we will try and answer them as we go along here. With that, Jamie, please take it away.
Thanks, Anders. Morning, everybody, and thanks to everybody for joining the webinar today. Anders, if you can just move on to the first slide for me. So I'd like to take the time with you to talk about the supply and demand situation in 2025, and then look a little forward and see what the outlook looks like for 2026. As you can see from the graphic and the slide, the effect of some of these peaks that have happened during 2025 has meant that both supply and demand has risen. We expect that supply is also likely to continue increasing during 2026, but at a much slower pace. We also expect that customer demand is also expected to increase, but the level is still going to be well below the capacity in the market. However, we do expect that the gap between supply and demand is going to grow slowly in 2026. But we also have to remember that this is an overall outlook for the total global market and doesn't always reflect what's happening on some of the individual trades like Trans-Pacific and Far East westbound. These trades obviously tend to be much more volatile. And as we've seen over the last 6 to 9 months, the freight rates on these trades have been going up and down during that period. It's fairly often fair to say that carriers do not and often hate the imbalance, as it often leads to rates dropping to unsustainable levels during these periods. Something that we've seen certainly on the Far East westbound trade in Q2 and again now at the end of Q3. And obviously with a little mini peak and demand in rates in between. But we've often seen, and this year in particular, rate levels on other trades, mostly on the eastbound from Europe and the southbound from Europe, have remained fairly stable. So Anders has already touched on some of the topics that I want to go through, but just want to give you a little bit more detail on some of the factors that have contributed to the market conditions for this year. And some of those conditions that we see are going to go through into the outlook for 2026. So again, as Anders has already mentioned, we take ourselves back to April 2025. We can all remember the storm caused by the US administration on Liberation Day, as Donald Trump called it, and the tariffs that followed. This action led to an immediate drop in bookings on the transatlantic and the trans-Pacific trades in and out of the USA. Importers cancelled shipments that would initially be impacted by these tariffs, and we saw a complete drop in demand. As soon as this happens, as usual in this up and down market, rates started to drop as those uncertainties in the market continued. The carrier fraternity then decided they were going to take some immediate action and then started to reroute vessels and schedules, especially on the Trans-Pacific market, which was the most affected. So we then saw these vessels move into other trades, and obviously the capacity was absorbed into those trades on a short-term basis. Some of the capacity was moved into the Far East westbound trade, but that also meant that that trade was over capacity for a short period. And as you may remember, the Far East westbound market into North Europe was fairly soft, and the rates were fairly low in the second half of Q2. However, it didn't take long for the affected countries to agree on a consultation or grace period. And then that also meant that we saw an immediate return of increased demand, and those vessels that had to be rerouted and deployed on other trades were brought back into the Trans-Pacific trade. As usual, the normal factors take over, demand outstrips supply, and we see a dramatic increase in freight levels. So again, a little bit of information now about how the carriers are going to react to this increasing supply chain gap for the rest of 2025 and also into 2026. So we're unlikely to see anything new, if I'm honest. They'll probably move forward as we've seen over the past few years. Carriers will adopt the usual tactics of blank sailings and full service loop removals in order to prevent the gap widening further. There's also a whole host of blank sailings in and around Golden Week in China at the beginning of October. And I'd expect that this will continue through the soft period. One measure that will also the carriers will consider in 2026 is a return to slow steaming, something that we haven't really seen since 2023. If people can remember that 2023 was a very flat and soft market, and this tactic was often used to create an artificial reduction in capacity. However, blank sailings and vessel loop emissions always have a downside, and we often see during that period there's a negative impact on schedule reliability, which is still today below where we saw the schedule reliability pre-COVID-19. Slow steaming, whilst it's going to have some benefits, is also going to have the least impact on schedule reliability, but it's obviously also going to help to reduce the amount of fuel that's being used to run those vessels, and will also help the carriers achieve their CO2 emission targets. But circling back to the original topic of the US administration, this still, for me, remains the biggest factor in market changes going forward. Whether that's additional tariffs implemented by the US administration or countermeasures adopted by those affected countries, we should expect some turbulence, some up and downs in the coming months. One of the topics that's still a little bit lacking in information is the potential tariffs on Chinese-owned carriers and vessels. Still to be resolved, and as I said, the information is a little bit lacking coming from either side. But there's obviously a deadline coming up in the middle of October, and I'm sure that we'll have some more details and we'll share these very soon. It's fair to say that probably COSCO and OOCL will be as the Chinese carriers will be the carriers worst affected, and they're also big players on the Trans-Pacific trade as well. Sorry, Anders, could you move on to the next slide for me, please? Thank you very much. So yeah, a little bit about port congestion. Yeah, not going to dwell on this too long. I think Patrick got some information on this section as well, but it's just to highlight the current picture as of August this year, also showing the capacity and the number of vessels that are sitting idle outside of the key ports in each of the regions, including the number of days that those vessels are delayed. as you can see, that Asia and Europe are the biggest hotspots. As you can see, these vessels account for nearly 9% of the global fleet. I've already mentioned about slow steaming, and that's likely to play quite a big part next year. But what will likely happen with that is that it may lead to a reduction in port congestion, which is great news from a schedule reliability point of view, but bad news from a carrier perspective, as it's likely to drive more unwanted capacity back into the market. Again, something carriers ideally want to avoid. So I think for the time being, it's going to be a little bit cat and mouse over the next few quarters, while the carriers try and strike some kind of balance for the supply and demand situation. Next slide, please, Anders. Yeah, I guess Anders has already mentioned about the situation in the Red Sea, so it goes without saying that's likely to continue. As Anders has quite rightly said, it's unbelievably 2 years since the first attacks took place by the Houthi rebels on the commercial vessels in the Red Sea. And whilst these attacks have somewhat subsided, there have been some recent incidents. Back in July, the picture that you can see there was a commercial vessel that was sunk in full view of the watching media. And as expected, we expect that these attacks will continue for the foreseeable future, certainly while there's that political unrest in the region. Just to give you some facts and some data, particularly on the Far East westbound trade, it's estimated that it's taken an additional 80 vessels to plug that 2-week gap for the vessels to go around the Cape of Good Hope, in order for those carriers to maintain a weekly schedule on all of those service routes into the North Med and into the North Europe and into the Med. That accounts for roughly 7% of the overall global capacity. So as you can imagine, there's no real plans at this time for the carriers to start rerouting cargo through the Red Sea and the Suez, even if that was possible. Of course, from a carrier perspective, that would also mean flooding the market with far too much capacity, and obviously when those things tend to happen, we often see that the rates fall to unsustainable levels. So from my side, that's it from a ocean freight perspective. So thank you for listening, and happy to answer any questions that may have come in during that time.
Very good, Jamie, and thanks a lot for that update on the state of ocean affairs right now. We have received one question, and it's about the so-called Arctic Silk Road or Polar Silk Road, right? It has many names, but this initiative, particularly from China, right, to potentially start using the Arctic shipping routes with all that entails. Well, what are your sort of view on the status of that right now? Does it remain? Is it a project that's being prioritized? Is it likely to happen in the near term? Well, what's the status on that potential? And do you have any views on it, Jamie?
Yeah, sure. I mean, it's not a new topic, but it certainly made some headlines more recently. We're starting to see some of the smaller Chinese operators, for mainly Chinese clients, looking at that as a route. But realistically, I mean, it's not a route that's going to be something that we can rely on or even use on a regular basis. Even with this current situation, that passage is only available for a few months of the year. So it's not something that anybody's going to be able to rely on a regular basis. And I think we're still quite way off. And obviously, it's going to take a huge amount of global warming for that to become a viable option. Added to that, some of the European carriers like Hapag and CMA have already declared that they're not going to enter into any such routing, basically purely on the basis it's a sensitive nature and the topic of climate change. So yes, I think there'll be some options available, but it's not going to be anything regular like we have on all the other routes.
Well noted, Jamie. Thank you. Anything involving global warming, China and Russia is likely to be complex, right? And certainly
Correct.
This subject matter is no exemption from that group.
Absolutely.
Thanks a lot, Jamie, for that. And we transition over to good old Patrik Berglund for some thinking on the market status from Xeneta's point of view. How are you doing, Patrik?
I'm great, thank you, and thank you for having me on today as well. Man, it's quite a time to be alive, to be honest. When I think about what we've gone through for the past 5 years, when I'm hearing Jamie speak, there's so much that comes to mind in terms of what would be worthwhile spending our time on today. But I actually wanted to take a big step back, and I wanted to say that I think what Jamie's flagging, you said in the intro as well, to me it's all events that is going to move the balance between supply and demand. And the reason why I'm mentioning that is that this is a pure supply demand driven industry. It's not cost based at all. And my ultimate proof point on this is that over the past 13 years with Xeneta, I've seen ocean rates from Shanghai to Santos for $50 and $20,000 for a 40-footer, right? So it's the exact same box that you move from Shanghai to Brazil in Santos, right? For that price differential. And that is so far away from any cost base that you can find at the carrier side, whether it's loss making or substantially profit making. Now, what I think has changed over the past 13 years, and I'm going to share my screen, but if you can turn off screen sharing and then I'll put it back on if you can help me with that. But what I think has changed is that over the past 5 years, the carriers have learned that they don't need to adjust their rates with $50 or $100 or $150 when the market balance shifts. They can do $500 or $1,000, right? And this is extremely painful to be a shipper in, right? Because for any shipper, ocean freight is not core business. They have a product that is their core business, yet they're dependent on this industry. So I think what you guys are saying is that there's a lot of unpredictability on the horizon as well. And what I want to sort of dive deeper into today is, what is the data saying? Let's look at some of these trades. And I want to start obviously with like the biggest trade that we in Europe are exposed to. And I'm going to go to a bunch of different ones. But what I'm looking at here is China East main ports into North Europe main ports. I'm looking at the market average for the short-term market for a 40-foot container year to date. The year to date, you can see on the bottom here, it's down 58%, 60% from where we started the year. If I go 1 year back, you can see it's down 60.7%. And this is only possible because on a trend basis, there's too much supply versus demand, right? And then if I look on it on a 3-year basis, you can see exactly the point Jamie was making, that 2023 was rather sort of calm waters, but it was very low levels in terms of the rates. And at this point, you're in Q4 23, we're heading into loss-making territory for the carriers. So if they get any opportunity, which they got with the Red Sea situation, to jack up rates, it moves fast. And you can see here that it peaked mid-2024, and if I zoom in on that period, it's a 76% reduction of the average, not the spread, the low or the high end of the market, but the average of the market. And if I look at what's happening on the long-term market, just rolling into this view, the long-term contracts, you can see that they've been much lower for most of the period than the short-term market. But as per the last few days, the short-term market has actually dipped below the long. And this is an important inflection point, because what this overall means is that large volume shippers, importers into the Europe, are now on average paying more than the smaller importers. So this is creating much more downward pressure on the market for the carriers, because they know that they will renegotiate a lot of these contracts over the coming 6 months, and the big players expect to pay less than the smaller players. So that tells me that unless something happens and the carriers can balance the supply and demand equilibrium, they were going to see further reductions to the rates. And I think, Jamie, you outlined the sort of forecasted demand and supply, and that's not a rosy picture for the sell side. So we're quickly transitioning into a very strong buyer's market here. Now, we got to look beyond just rates. So I wanted to show you the same corridor, but just transit times. And I'm not focusing here on the announced ones. We're just looking at average. What did the industry actually do? And you can see the jump in 2024 when they needed to go sail around Africa, obviously, right? But then you can see it peaked here where the average was about 53 days to go China Main to North Europe Main. And you can see the spread. And then something has happened where it goes faster now, right? It's a 5-day difference to where we are today, right? And if I drill down on this, I think this is quite interesting to see what changed, especially this year with the Gemini Alliance coming into effect. And I want to add a couple of carriers. Let's have a look at MSC, the world's biggest carrier. You can see they've been trending upwards and are now sitting in the upper area of the spread in the market. So MSC is doing this on around 52, 53 days on average. And then if I add another carrier within this trade, let's do Hapag-Lloyd, which is part of the Gemini Alliance, you can see their shift from being incredibly slow relative to the others to now being amongst the fastest ones. So I think this is important to mention, and there's so much nuance to this, right? Because Hapag-Lloyd, for instance, has fewer direct shipments. If you go Yantian to Rotterdam, Gemini is performing stellar because this is one of their core hub-to-hub services. If you, for instance, goes into Le Havre, there's no direct options with the alliance, so there will be a transshipment, right? So it's now possible to buy different products from these carriers than it was compared to a year ago. And you can really see the big delta here. So if you have just-in-time supply chains, or if you're thinking about planning from a timing perspective, you can see that this equates to quite a lot of days and arguably more than a week, right? But if we go then into reliability and we look at the same trade still, just want to spend some time to dig deep, you can see that these two lines are more or less negatively correlated. So in orange, we have the reliability, and in blue, we have the price point. And as the market softens, you can see here back in 22, 23, reliability trends upwards. We're not talking about pre-COVID levels, but at least at this point, you could assume that half of the boxes would arrive on the planned time, right? And then when rates get high, there's a squeeze in the market, and you can see here reliability of 15.86%. That means that 15 out of 100 boxes, if I'm simplifying, will arrive on the scheduled time. So with the market softening, reliability slowly picks up again. And today we're sitting at 29.19. But here's the thing. If we take a carrier view, and let's do Maersk in this example then, and MSC, the products you're buying now is incredibly different. Maersk with 85% reliability now, a few weeks ago, a few months ago, plus 90. MSC, single digit reliability a few months ago, and now up to almost 13%. But you have to look at the underlying port pairs that they're servicing within this trade. As I mentioned with Le Havre as an example, right? So for the opportunity for shippers now to optimize, to really understand what they're buying and getting for the rates that is available in the market is a bit more complex than what it used to be a while back. So I think this gives a good example. Let me push us on. Let's look at the export side. Let me see. Actually, I want to mention one more thing. I want to say that there's differences between China to North Europe and these other regions as well. I just want to show you that if you go to, since we're based in Scandinavia, if you go to Scandinavia, you will see the market average in this graph. But if you go to Gothenburg, which has direct access as well, you can see how tightly correlated all these three origin destination combinations would be, meaning China main ports into North Europe, Gothenburg, or Scandinavia. But you can see the big difference of moving to Gothenburg versus the rest of Scandinavia on average. So important to understand that it's not the same going all of Far East into all of Europe, right? There's differences. Then I want to switch to another trade, or I want to show you a couple more examples where you switch on the origin side. And I want to show you Japan main, and then I want to show you, let's say, India West Coast. I want to highlight this so that the audience, the shippers, knows that these trades are not the same. Periods of time, you can see it's more expensive to go from India West Coast versus China main, or way cheaper to go from India West Coast. As per today, they're quite closely connected, but just a few months ago, there was huge price differentials on these trades. All the trades I've looked at so far is sort of Far East into Europe, and they all have a strong downward trend, which goes back to the beginning about the underlying dynamics in the market, where it's too much capacity and too little demand. Export out of Europe, let's do that as well. I don't know, from a shipper point of view, arguably good news. Sub $100 average short-term market, right? This is heavily subsidized by the front haul trades that we just looked at, obviously, because they want the boxes back so they can make more money on the front haul. But we all know that the front haul is quickly trending down to 2023 levels, and that's when it's going to be messy for the carriers. Now, let me show you a bit more. Let's do add US East Coast as an example, right? Because it's not necessarily all the same, but you can see still, if you do export into US, you can see how this market has fallen off a cliff just in the past 3 years, right? And what I'm trying to find is like, where will the carriers make their money if this continues as a trend? If you go South America, East Coast as an example, or we can go into Mexico, right? Let me see if I can add that as well. We all have the same picture here. And I can do the same into Australia or New Zealand. It's all trending down. And I think what I really want to hammer home is that supply and demand is so in favor of the shipper now. And all these trades are trending down. But historically, we've seen if anything happens, the carriers are quick to jack up rates significantly. And that's what I would be on the lookout for. But most of the forecasts, like Jamie mentioned, if you look at the planned deployment on the fleets, if you look at the planned scrapping of vessels, if you look at the forecasted demand, nothing is really in favor from the carriers' point of view as per today. Now, change quickly. The product that the shippers can buy can come at higher reliability if you're picky on your suppliers, knowing which carriers can service your supply chains the best. So there's a lot of value to be extracted from shippers, from my point of view. Then on a final note, the only thing that we most likely know is that at some point, the Suez Canal will be reopened. It looks gloomy. I agree with Jamie on that, and it's probably going to take time. But if it reopens in a state of the market today, that will flood the market with additional capacity, and it will create an immediate congestion situation in Europe that is going to be difficult to deal with. But once that is solved, I think the carriers will need to do something drastically in order to balance the market. And they will not sit still and just watch this unfold. I think those are my main points for today.
Great stuff, Patrick. Thanks a lot for that. As usual, very informative. We have received quite a few questions as you were speaking, but thankfully you managed to cover most of them while you were talking as your speech sort of progressed, Patrick. But one question which I think might be of interest to most people in in the webinar I want to ask you, and that is roughly or exactly, if you like, what production cost for the Far East westbound trade, Asia, Europe to North Europe main ports, would you consider to be the break-even point for a carrier with current fuel prices and everything sort of where they stand right now?
So it depends. You got to look front haul, back haul, right, and see where. But it's hard to. We've done estimates on the cost per TEU for Hapag and Maersk and so forth, because they're publicly listed companies. But what I usually have got as a rule of thumb, if there's a couple of $100 to be made on the back haul, and plus 1,000 or 1,200 on the front haul, they seem to be more or less break even on that combination. But that's a painful point in time for them. And then in 2023, end of it, we were one of the few that said there's very little that needs to happen in the market for the carriers to get some type of leverage for them to jack up their rates significantly, and then something extreme happened with the Red Sea. But they will be positioning themselves for something to happen if this downward trend continues.
Well noted, and thanks a lot, Patrick, both for the presentation and for the answer to that question as well. With that, we transition and we look to the skies, where we hope to find Thomas Elmelund to give us an update on the state of affairs on the air freight front. Over to you, Thomas.
Thanks, Anders. True, I will give you a brief insight to the air freight market. We're going to go through the capacity. We're going to go through the demand situation. We're just going to touch on the e-commerce and the change of patterns within the e-commerce segment. And then we're just going to run through some of the trends that we expect going into Q4 and also going further. But if we start on the capacity side of things, then we do not have the same imbalance as we do here on the ocean freight. There's much more balance between capacity and demand, but there are quite a few geographical differences in where the capacity is needed. But if we look into the growth in capacity in 25, we have actually had a growth in 5% compared to 24. And the majority of this growth has come from the Far East westbound corridors. So basically meaning from APAC into Europe, we're seeing a huge growth in the capacity, primarily driven on the huge increase in the e-commerce, but also just in general from the warm markets in the Southeast Asia and APAC region coming into Europe. So that's primarily we're seeing the big growth this year on direct routes into Europe, but also the indirect through Middle East coming into Europe. And that's of course a lot to do with the minimus being waived in the US, but also all the tariffs in the US. So now the capacity is finding now new routes to fly. We're also seeing that the passenger, the belly capacity is actually back at pre-COVID levels, which is actually the first time in years that we're seeing a balance in that before pre-COVID and now. But if we look into Q4, then we're actually seeing that the upcoming winter season starting the 1st of November, we expect a decline in the scheduled capacity of 11%. And this is especially true on the transatlantic routes between Europe and America. So a lot of that leisure travel and a lot of the business travel is actually going to be reduced. This is not anything new. That always happens going from the summer season into the winter season. But we do, however, expect that this time around it's going to be a little more than we normally see. And that's simply because that there's a very weak ticket sales between Europe and Americas. And that also means they'll probably take even further departures out than they normally do between summer and winter season. So we do expect a lot of the passenger travels being reduced between the transatlantic. What we do expect also is that the freighter is going to be redirected into the Southeast Asian markets and China, because this is basically where the big demand is. So that also means that we do not expect a big or significant introduction to freighter capacity in Americas, because that's basically not where the demand is. So if you look into the demand side of things, then we're actually seeing on the demand side, if you just go to the next slide, Anders, that we saw the demand actually increase much more than we expected in 25. It's actually up 12%. And the main driver for this is obviously the inbound US volumes. We have seen a lot of export being shipped to the US, either ocean freight converted to air freight or just a lot of orders that is being shipped prior to the tariff being implemented. So a lot of people are trying to get ahead of the tariffs. That also means that we saw a strong growth on the US inbound. We still see that for some markets where they're not yet settled within the tariffs, but that's been the main driver for the demand flow. Then we also see that e-commerce, especially from the Far East coming into Europe, they are now targeting Europe after the de minimis exception was reduced in the US. So now they're targeting Europe more than in the past. So we're seeing a 25% increase on the e-commerce to Europe, and we're actually seeing e-commerce basically increasing to every market except for the US market. And at the same time, we're seeing that all the cloud and AI commodities, which is very heavy on the Southeast Asian region, is very much a growth on the demand side of things as well. If you go into the next slide, Anders, there's just to touch base on the e-commerce and why that one is still a massive volume driver, or at least a demand driver. If you look at the first column, then you can see the e-commerce. When US removed the de minimis exceptions, that's basically everything below $800 in the past, you didn't have to custom clear and you didn't have to pay taxes or tariffs. Now you have to probably clear it, and you also have to pay the right tariffs in the US. And actually that often is more than actually the value of the commodity you're buying. That made the e-commerce to US drop dramatically. Right now it's nearly halved the e-commerce into Americas. In the past, that was 30% of all e-commerce that was being sold in the American market. But if then you look at the third route, then you can see the e-commerce to the rest of the world has just highly increased, and just speaks volumes that these major e-commerce companies such as Temu and Shein, despite they have lost out about half of the biggest markets on the US, which accounted for 30%, they still grow the total numbers on e-commerce by 12%. So the ability to grow new markets within a very, very short period of time is quite impressive. And then look at the other commodities into the US from China, then you can kind of see the same pattern as you do for the e-commerce, that once Trump implemented these high tariffs towards Asia, we saw a fairly high decline in volumes into the US. But it seems actually as China have managed to, find the new markets for those that they have lost in the US. So we're seeing other markets quite taking an increase in volumes. And that being said, then I do expect that, these chains of pattern, these high volumes being changing new routes will create some congestion and probably also some bottlenecks in some airports, simply because the volumes is increasing at a higher pace than they can train and hire new staff. So I think we're going to be in for an interesting Q4 coming into Europe. And actually lead me to the next slide. If you just go on ahead, Anders. What do we expect for the coming period of time? Basically, we do expect that changing tariffs will continue to make this global trade volatility and result in these unpredictable air demand swings. We also see that this China plus one sourcing strategy will drive the demand out of the Far East Asian region, but also out of the Indian subcontinent. The IA and the cloud commodity is by far the hottest commodity within the air freight market right now. Everything is being flown simply because time to market is essential. And we see those probably will still continue to grow double-digit numbers. On the other hand, we see the automotive industry, which has always been a big driver, especially out of Europe with the German automotive industry, is losing a bit of momentum. That might be tempering a bit on the outbound volumes out of Europe, that we are not having this massive driver in terms of export volumes. And then we do expect also that the freighter capacity increase is somewhat going to be stable, because we see that production is slow, but we're also seeing that the slots that they have and the new builds, they're already sold way into 27. So we won't see a major increase in terms of the freighter capacity. And then finally, we're also seeing that the mandatory sustainability cost will continue to add to the air freight cost. We saw that in the early 25, where EU implemented the Refuel EU initiative, where 2% SAF has to be blended into the tanks, came with a minor increase in rates. We will see the same in the Far East, and also especially in the Far East and Australia and New Zealand. That's going to come in 26 and 27, still with 1-2% in terms of SAF fuel, but that number will increase and obviously also add to the cost. And then, of course, the big question, I guess, for everybody is, how is that going to pan out in peak? We do believe that the Trans-Pacific peak is going to be very modest because we don't see a lot of volume moving between Americas and Asia, so that's probably going to be modest this year. When it comes to Europe, that's a bit more of a question mark actually, because we do see rates is gradually climbing, and we do see there's a strong demand throughout Europe. So I think there will be somewhat of a peak coming into Europe from Asia, but where the level is going to be is still uncertain because we don't know what capacity is going to be moved away from the US to Asia. The only problem we see is that the revenue string is very much one-legged. So basically, they take 85% of the revenue has to be earned on the way into Europe, and very little on the flight back. And obviously, the more capacity you add, the harder it is to find that balance. But time will tell. I do still think that we'll see somewhat of a peak during Q4. But if it's going to be as bad as last year, I'm not sure of that necessarily. But that's just my 5 cents on the air freight. Unless there's any questions.
Thanks a lot for that, Thomas. I guess the market circumstances substantially different than ocean right now in the behavior of rates and what the market is going, but still not calm, right? I guess turbulence would be the air freight vernacular to apply to the market movements right now.
We see the same dynamics as we do on the ocean freight, and Trump obviously is still going to be a joker in all of this. Tariffs being entered, there's being paused, they're going to be re-entered. So we have that stop and go on the air freight as well, which is going to have these unpredictable demand swings as we've seen also out of Europe in the first half of 25. I think that's going to continue probably for the next 3 years, at least for the time to come.
All right. Well, that is, as you say, Thomas, right? Time will tell. Before we hand over to Christian for an update on road freight, just one short question for you as well, Thomas, that we've gotten from the audience about temperature-controlled air freight, the specific segment of air transportation, right, where the customer has been struggling to get quotes for food temperature control with basically the airlines refusing to offer it. Are you seeing any trend lines in that direction, that this is becoming tighter capacity for temperature control? Is this an aberration, or how do you view that specific niche market?
Yeah, no, it could be carrier specific, could be destination specific, but we still have a lot of temperature control, both within the pharmaceutical and within the foodstuff segment. So you have those regular temperature control departments. What might be a difference is that you often they can only have one temperature, and they are normally not allowed to have both foodstuff and pharma in the same compartment. So that could be one of the reasons. But we do normally see that they do accept foodstuff, but only on specific departures though. So they don't blend it on the temperature.
Well noted. I'll put on my salesman hat then and basically recommend to simply get in touch with Thomas, and he'll try his level best to score.
Reach out to one of our teams because it is doable. It might come with a bit of margin on the rate, but it should be doable for sure.
Very good. Thanks a lot, Thomas, both for that answer and for the update in general. Much appreciated. So with that, we burn some rubber here and look to the roads. Christian, over to you.
Thank you very much, Anders, and for being able to joining the webinar. Yeah, some short comments about road freight, actually. And I would actually like to start to speak about the new DSV road coming up in Scandinavia, but also, of course, in the world. But speaking about Scandinavia, we are now working quite hard in all the countries for going live. And going live means that we merge to one company in each country. And we expect that to be done by the first quarter of 2026. And that creates enormous possibilities for us, because DSV and Schenker, we are the two major players on the Scandinavian market. And what we will create with this new merger is an enormous powerhouse and tremendous possibilities on the road market. Frequency, capacity, and lead times will be top notch for us to offer the market in the future. It is many years of experience that we put together in one company, and we will take the best out of two worlds. The fantastic network that Schenker brings for groupage, and the operational excellence that DSV holds for part loads and full loads. So that will give, once again, enormous possibilities for the market in the future. We're looking strongly and firm towards it. In front of you, you can just see a flavor of what we will be able to do on the direct traffics. And direct traffics, that's part full loads within the Scandinavian markets. Just in Sweden, we will have more than 5,000 domestic trucks running on the roads each day. So we are really looking forward on that. Coming back to the other international traffics, we can now see, if you change to the next slide, please, Anders. We can see that the demand for transportation has actually increased after summer. And it takes us a little bit by surprise, not too much, but a little bit. There is a really strong demand out on the market these days. We have several times spoken about the lack of capacity because of lack of drivers on the road market, and that continues. And we can see now that when the demand for transportation increase, and we see that drivers from Eastern Europe are not coming back after holidays, the capacity constraints is increasing quite rapidly. We see on the freight platforms how the volumes more or less explodes. And when volumes are ending up on the platform, means that the normal carrier are not able to take the volumes promised from the very beginning. So something is happening. And what we hear from our hauliers is that they are in trouble to getting the drivers back. First of all, they have taken a way longer vacation than normally. So I would say that when they are coming back to up to 3 weeks later than normal. And some of them are actually not turning up at all because they have found other works closer to home. At the same time, there are discussions in Poland where Donald Tusk is not planning to give permission or permits for the Ukrainian drivers, as has been a main part of the drivers on the Polish trucks. So that also creates challenges. In DSV, we have, during the last years where we have seen these capacity constraints, moved a lot more of our volumes towards intermodal solutions to compensate for the lack of drivers. Unfortunately, also this transport mode is now challenged by different things. And if you look to the international routes and then mainly Italy and Germany, we see extensive infrastructure works within Germany that creates a lot of problems for us, coming to lack of capacity, longer lead times, and higher cost for local trucks. So what can you do to mitigate that problem? Yeah, there is only one way actually, and that's try to shift back to road. But the problem with the driver makes that difficult. So it's like moment 22, where we are at this moment, and we can see that the freight costs are increasing rapidly. Hopefully, a lot of the drivers and the capacity will come back, and we will see a lot better KPIs on the rails. Then we will see the freights and the lead times going back to normal. And if you change slide once again, you can see that the intermodal challenges are not only impacted by construction work, but also for the climate change. And what we have seen here during the late summer in Norway and Sweden has created enormous challenges from the northern part of these two countries, where we are really dependent on rail solutions because of the distances we are speaking about. The heavy rains that we have seen in these two countries after summer have created a big challenge for us. And because of that, I will be really proud to say how we have solved the solution yet by road. but still, it's an effort that we need to do every day. We expect this rail to be back to normal within 2-3 weeks, and then hopefully it will stay for over a period. So that actually was the main topics that I would like to bring up from road today, Anders. And I don't know if there are any questions for road.
There are indeed, Christian, quite a few actually, but much like Patrik, you were in the good graces of being able to answer several of them as we went. But one question I think could be of interest to get your input on, Christian, is a question about sustainability on road transportation, and whether you expect that the merger or acquisition and integration of Schenker will bring additional possibilities in that sort of category, right? Or is it developing strongly anyway? Or how do you view sustainability going forward for road transportation?
I think it will. We had the development within DSV in a high pace already today. Of course, we will gain some knowledge also from Schenker, but the pace is really strong within DSV today. We had signed a letter of intent to buy 300 electric trucks from Volvo, where DSV has signed that letter of intent. And we are placing them all around Europe and also all around the world already today. And we see that I would say a big increase of our fleet is now running with HBO 100, where we save up to 90% of the carbon compared to normal diesel. If you look to the green solution that we had, you should actually also add the intermodal solutions, where it is really a big impact on the savings for carbon on long distance transport. So I think there is a high pace and strong motivation to bring this forward. What we see is that the last year, the development of electric trucks has slowed down a little bit. The focus is to save carbon, and you can do that quite good also with the alternative fuel as we are using today. So I would say that, of course, we will bring the best from two worlds, but we have already now a really good pace in developing the green solutions.
Fantastic, Christian. That sounds promising and glad to hear, because we do read a lot about, as you rightly mentioned, right, the road transportation transition, not just for cargo movement, but for personal vehicles as well, unfortunately slowing down a bit. But glad to hear that for us at least, and for the near to medium term, we are still trying to accelerate our efforts going forward, which makes me really glad to hear. With that, we are very rapidly closing in on the end of this webinar here. We've managed to cover quite a few of the questions we received, and we've got a lot of questions today, which I really appreciate. So do feel free to reach out to us, to me. You will get my contact information on a slide here in a second, and I'm happy to put you in touch with the appropriate member of this panel to answer your questions as well. And thanks a lot for sending in those questions. We will be back with another quarterly market update webinar on December the 11th. Let's maybe hope against hope that the world has settled down a little bit until then, but regardless of whether it has or not, you won't want to miss that webinar. So to make sure that you receive the invites, I would recommend you to either follow us on LinkedIn or subscribe to our sendouts at dsv.com. For any questions or input, as already mentioned, that you sent, which we were not able to cover, or for any other questions or input that you might have, please feel free to reach out to us. We will be happy to take the discussion and to try and provide you with an answer to the best of our abilities. Lastly, a big thanks to Jamie, Thomas, Christian, and Patrik for joining me today. And with that, I wish you all a great rest of your week and hope to see you next time. Goodbye.